Okay. You're on.
P-Tech Course 3, Income Approach to Value, Section 2, Review Questions and Answers. What is an income-producing property? You know what would be cool?
Okay, let's go.
An income-producing property is real estate purchased as an investment. It is a piece of real estate that is purchased for the potential return on investment that it offers. The return on investment comes from two principal areas: rental income each year and appreciation in value of the property over the term of the investment or holding period. Number 2. What are the factors that influence real estate investor behavior? Number 1. Investors look at the safety or the risk of their investment. Risk and return are related. Risk and return are related. Higher investments require a higher rate of return to attract investors. Number 2. Real estate is less liquid than other financial investments. It is much easier to convert a CD or treasury bond to cash than to sell a piece of real estate in a short period of time. Number 3. Real estate investments typically require substantial cash investment. Consequently, small investors may not be able to participate in the investment category. Number 4. Real estate is a source of collateral for loans. Number 5. Real estate investments are typically viewed as long-term investment. Number 6. Real estate investments often require that the investment must be managed. Some investors do not have time or the experience to do this. Number 7. A real estate investment offers the possibility of return from rental income and price appreciation. Number 8. Real estate offers income tax advantages from depreciation accounting methods and the opportunity to defer taxes by using tax-deferred exchanges to dispose of the investment. Number 3. What is the difference between market value and investment value? Market value can be called the value in the marketplace, assuming no specific buyer or seller. Investment value is the specific value to a particular investor, reflecting the attitudes and perceptions of one specific investor. Market value is objective, impersonal, and detached. Investment value is based upon subjective and personal parameter of their investor client. Investment value may equal marketplace if the investor's perceptions or requirements are typical of investors of the market. Did that make sense? If the investor's investment's value may equal marketplace if the investor's perceptions and requirements are typical of investors in the marketplace.
They put a period.
They put a period instead of a comma. I didn't think it made sense. Number 4. What is cash equivalency analysis, and why is it important to commercial real estate valuation? The estimate of market value requires the assumption that it is the price that a property would sell for in terms of cash or similar terms. Occasionally, a property will be sold with typical financing.
No, with atypical financing.
With atypical financing. There are 3 types of atypical financing. Number 1, the buyer assumes a mortgage that has a below market interest rate. Number 2, the seller provides the financing to the buyer at a below market interest rate or other favorable terms. And number 3, the seller prepays points on a loan to buy down the interest rate for the buyer. Comparable sales with atypical financing must be adjusted using cash equivalency techniques before they can be used to determine the market value of the subject property. Number 5. When is the appropriate discount rate based...
What is the appropriate? Slow down.
I'm not going fast. I can go faster. What is the appropriate discount rate based on the given information? Given risk rate equals 2%. Safe rate equals 4%. Non-liquidity rate 2%. Management rate 2%. Property tax rate 2.5%. Safe rate is 4%. Risk rate 2%. Non-liquidity rate 2%. Management rate 2%. Discount rate 10%. So
the answer is highlighted. It's 10%.
Okay, I want to note in my copy it's not highlighted.
How could it be? We're looking at the same copy. Okay. All right, go.
P-TECH Course 3, Income Approach to Value, Section 3, Review Questions and Answers. Number 1, explain the difference between potential gross rent and effective gross rent. PGR is the revenue a property would generate if operated at full capacity throughout the year. EGR takes into account the V&C losses a property would typically suffer. Number 2, you are appraising an apartment complex containing 50 units. 10 3-bedroom units rent for $575 per month. 15 1-bedroom units rent for $300 per month. The remaining units are 2-bedroom and rent for $480 per month. What is the potential gross rent for the apartment complex? First, you must find the total number of the 2-bedroom units. Subtracting 10 3-bedroom and 15 1-bedroom units from the total of the 50 gives you a remainder of 25 2-bedroom units. Multiplying the number of the units times the monthly rent gives you the monthly rent for that type of unit. Multiplying the monthly rent per type times 12 gives you the annual rent. The total of the results is PGR. Do you want me to read that chart?
No, that's okay.
Number 3. You are appraising a strip center with 27,800 square feet of leasable area. Market rents are $11.25 per square foot per year. The V&C loss rate is 14%. Allowable operating expenses per year equal $102,207. Assuming no miscellaneous income, calculate the potential gross rent, effective gross income, and NOI. PGR is equal to size times price. So your PGR is equal to 27,800 square feet times $11.25 equals $312,750. V&C loss is equal to V&C rate times PGR. And so that is 0.14 times $312,750 equals $43,785. Effective gross rent is equal to PGR less V&C loss. Effective gross rent is then $312,750 less $43,785 equals $268,965. Effective gross income is equal to effective gross rent plus net miscellaneous income. Effective gross income then is equal to $268,965 plus 0 equals $268,965. NOI is equal to effective gross income less allowable expenses. So NOI is equal to $268,965 less $102,207, which is equal to $166,758.
Hey, you did the numbers good.
Number 4. You are appraising an apartment complex with 32 units. 22 bedroom units rent for $425 per month. 12 one-bedroom units rent for $280 per month. The V&C loss rate is 18%. Net miscellaneous income equals $4,400. What is the property's effective gross income? PGR is equal to 20 times 425 times 12 equals 102,000. The 12 times 280 times 12 is equal to 40,320. Add those together to get a total of $142,320. V&C loss is equal to $142,320 times 0.18, which is equal to $25,618, and you're going to take that away from the PGR total to get a total of $116,702, and that is the EGR. Then you're going to add miscellaneous income of $4,400, and that gives a total EGI of $121,102. Remember that you use rental income only. Remember that you use rental income only or other primary income to calculate the V&C loss. The V&C rate does not apply to miscellaneous income.
Yeah, those little notes like that, those are helpful.
Helpful? I can read that and be helpful too. Number 5. You are appraising a small office building containing 5,000 square feet of leasable space. It rents for 95 cents per square foot monthly. The owner pays all utilities and maintenance costs. Comparable office space in your market rents for 55 cents per square foot. What is the potential gross rent for this property? The PGR for this property is $33,000, which is 5,000 square feet times 55 monthly rent times 12. You calculate PGR using the economic rent of 55 cents, not the contract rent of 95 cents. If economic rent is based on contracts that typically call for the owner to pay utilities and maintenance, you would allow those expenses. Otherwise, they are disallowed, and you instead subtract only the expenses a prudent property owner or manager would pay.
Which they didn't. Well, never mind. Go ahead.
Number 6. The following table shows the replacement cost and economic life of various appliances in a 27-unit apartment complex. Use this information to calculate the annual reserve for replacement.
Just go down to the answer part. You don't have to read what's there, because it's going to be restated in the answer. If you can read that answer, that total answer.
Multiplying the number times the cost per unit gives you the total cost for each individual property component. Dividing that total by the number of years gives you the reserve per component, such as type, refrigerator, number 27. You're going to multiply the 27 by the $300 cost divided by the 8-year life, which is equal to the annual reserve of $1,013.
That 27 is a number, a quantity.
Right, it's the number of units, is it not?
Yeah.
I scrolled the wrong way. Okay, so now then the next thing is your stove. There's 27 of those, times the $110 divided by the 20-year life is equal to an annual reserve of $149. The dishwasher, there's 27 of those. Multiply that by the $150 cost, divide that by the 10-year life equals $405. The hot water heater, there's 27 of those. Multiply that by the $180 cost, divided by the 10-year life equals to the annual reserve of $486. There's only one roof. It is $18,500. Divide that by the 25-year life equals the annual reserve of $740. There are 350 linear feet of fences. Multiply that by the $1.25 cost, and then divide that by the 15-year life equals $29 annual reserve. There's 2,800 square feet of carpet. Multiply that by the $8.25 cost, divide that by the 12-year life equals $1,925. You're going to add all of those annual reserve numbers up to get a total annual reserve for your replacement components of $4,747. The sum of the yearly reserves per component equals the annual reserve for replacement. Number 7, which is highlighted with a little blue bobble.
Yeah, they said when she took the course that it could be on that level 3 exam.
Let's see. Okay, number 7. You are appraising a property with a potential gross rent of $65,000 annually. The V&C loss is 8%. The management expenses expense is 4% of the effective gross income. Other expenses total $27,500. Miscellaneous income equals $5,000. What is the NOI? PGR is equal to 65,000. V&C rate is equal to 0.08. V&C loss is then $5,200. EGR is the 59,800, which is the 65,000 less the V&C loss of 5,200. Then you're going to add the net secondary income of $5,000, giving you the EGI of $64,800. Your management rate is 0.04 multiplied by the 64,800, giving the management expense of $2,592. And then you've got other expenses of $27,500. You're going to subtract the $27,500 and the $2,592 from the $64,800 to give you total expenses of $30,092, giving you an NOI of $34,708, and you arrive at that by taking the $64,800 less the $30,092. So I need to back up and correct something that I said.
Yeah, I know what you were saying.
Yeah.
I know what you were trying to say, but that's okay.
Yeah, you don't subtract the 27,000. Well, you do in a roundabout sort of way subtract the 27,500 and the 2,592 from the 64,800, but they want you to arrive at that number, I think, of total expenses.
Yeah, they want you to just add it up together. You don't have to reread it.
Well, I wasn't going to reread it. I was just clarifying what I had said on the recording for future purposes.
For the benefit of the listener.
For all of the people. Number 8. Explain the difference between contract and market rent. Contract rent is the payment specified on a rental contract. Market rent is the amount a prudent tenant would pay to rent a property from a prudent landlord. Market rent assumes that both landlord and tenant seek the best deal they can make and that neither is in a position to take advantage of the other. Appraisers should use market rent to estimate PGR. Number 9, the little blue bauble on it. Which of the following expenses would be allowed in reserves for a replacement for an apartment complex? Why or why not? $2,000 per year for carpets. Allowed. $1,500 per year for the roof. Allowed. $250 per year for parking lot blacktop. Allowed. $1,000 per year for pool maintenance. Disallowed as a reserve.
Disallowed as a reserve. Allowed as a variable expense.
Okay, so that they're making that differentiation there. So if
because what the question asks.
Right. Okay. So $2,500 per year for new units, disallowed. $3,000 per year for construction of tennis courts, disallowed. $25,000 in first year leasing commissions, disallowed. The expenses for carpets, the roof, and parking lot blacktop are allowed. In each case, the expense is necessary to replace an item with a shorter economic life than the building itself. Pool maintenance is allowed, but it does not fall into the reserves for replacement. It is a variable expense. The expenses for new units and new tennis courts are disallowed. These expenses are not necessary to maintain the property's current income stream. Instead, they are expenses for expanding the operation. The $25,000 for leasing commissions in the first year of operation is disallowed. These are not recurring expenses. Given the amount, a property owner would probably recover these expenses over an extended period. You could disallow these expenses entirely on the grounds that the owner recaptures them through the recapture rate, or you could allow a reserve buildup over a number of years, for example, $5,000 per year for 5 years. Your actual choice would depend upon prevailing management practice in your area and on your method of rate construction, particularly construction of the recapture rate. Number 10, with a little blue bubble. You are appraising a 30-unit apartment complex. The following chart shows the types of units and market rent for each type. The V&C loss rate equals 17%. Miscellaneous income equals 3.5% of effective gross rent. Expenses equal 32% of effective gross income. What is the property's NOI? Unit type, 1 bedroom, number of units, 10, monthly rent, $325. Unit type, 2 bedroom, number of units, 15, monthly rent, $490. Unit type efficiency, number of units, 5, monthly rent, $200. It's giving different...
The first steps. First step is calculate PGR.
So the ABCD are steps, not necessarily answers?
No, those are steps. Well, they are answers, but they're steps that you gotta do.
Okay, so A, calculate PGR. You're going to take your unit type, your number of units, and multiply it by its monthly rent, and then multiply that by 12.
Which is... They're multiplying that by 12 because that's the number of months.
Yes.
12 months.
For the year.
Mm-hmm.
Yes. So 1 bedroom, 10 times 325 times 12 equals 39,000. 2 bedroom, 15 times 490 times 12 equals 88,200. Efficiency is 5 times 200 times 12 equals 12,000. Add those all up to get a PGR of $139,200. B, subtract V&C loss to get EGR. V&C loss is equal to the $139,200 times 0.17, which is equal to 23,664. EGR is equal to the 139,200 less the 23,664 equals 115,536. Step C, add miscellaneous income to get EGI. Miscellaneous income is 115,536 times 0.035 equals 4,044. EGI is then equal to 115,536 plus 4,044 equaling $119,580. D, subtract allowed expenses. Expenses are 119,580 times 0.32 equals 38,266. The NOI is then equal to the 119,580 less the 38,266 equaling 81,314. What is NOI again?
Net operating income.
Net operating income.
It's the I in the IRV triangle.
Okay. You are appraising a 25-unit apartment complex where the owner pays all utilities. 10 one-bedroom apartments rent for $350 per month. 10 two-bedroom apartments rent for $500 per month. 5 efficiency apartments rent for $225 per month. In your area, owners do not typically pay utilities. Typical monthly rents in the local market are $225 for 1 bedroom, $350 for the 2-bedroom, and $150 for the efficiency. What is the potential gross rent for your subject property? So your unit type is efficiency. There's 5 of those. Multiply that by the $150 a month of rent times 12 months equals 9,000. The 1-bedroom unit type, there's 10 of those. Multiply that by $225 monthly rent times 12 months equals $27,000. 2-bedroom unit type, there's 10 of those. Multiply by $350 rent times 12 months equals $42,000. Add those all up, the PGR is $78,000. B, if the V&C loss rate is 5%, what is your subject's gross rent?
Effective gross rent.
What did I say?
Just gross rent. It matters.
Oh, I thought I said effective gross rent.
Yeah, just read the question again.
If the V&C loss rate is 5%, what is your subject's effective gross rent? PGR is equal to 78,000. V&C rate is equal to 0.05. Multiply that by the 78,000. Your V&C loss is equal to 3,900. EGR is equal to 78,000 less the 3,900 equals EGR of 74,100. Number 12. You are appraising a small office building containing 4,000 square feet of leasable space. The lease calls for the landlord to furnish the offices and to pay all utilities and janitorial fees. Typical rents for comparable properties in your area are 65 cents monthly, which is circled, per square foot for unfurnished office space. The tenants pay utilities and janitorial fees. The appropriate V&C loss is 6%. Management is 4% of effective gross income. You receive the following expense statement from the property owner. Given the available information, what is the property's NOI?
You can just read the steps, the bolded steps.
Okay. The first step in calculating NOI is to determine PGR using economic rent. PGR is equal to 4,000 times the 65 cents times 12 equals 31,200.
Now let me stop you there. Remember how the monthly was circled?
Yes.
That's why we did it. The answer tells you to multiply that the rent per square foot by 12 because you're supposed to annualize everything.
You next subtract V&C losses to arrive at effective gross. PGR is equal to 31,200. V&C rate is 0.06. Multiply that by the 31,200 to arrive at V&C loss of $1,872. EGR is equal to 31,200 less the $1,872 equals $29,328. In this case, EGR equals EGI because there is no secondary income generated by the subject. After determining EGI, you must examine the expense statement and subtract only those expenses required to maintain the property's income stream. Debt service and building depreciation are always disallowed. We divide the RCN by economic life to calculate reserves for replacement. Expenses for utilities and furniture rental are disallowed because the economic rent used to calculate PGR did not include the increased rent a prudent manager would require to compensate him or her for these expenses. Since the income stream does not reflect that additional income, we cannot subtract it as an expense. Subtracting allowed expenses from EGI yields an NOI of $17,325. Here is a reconstructed operating statement.
You don't necessarily have to read that because we didn't read the first one, and so this one's not going to make too much sense.
Sure.
Okay, go.
You are analyzing apartment rents in your appraisal district. You have collected the following information on 6 properties. Based on this information, what is prevailing market rent in your area and what are the typical terms? The typical apartment in this area is unfurnished, 5 to 6 properties, and the tenant pays utilities.
5 of 6 properties.
Okay, unfurnished, 5 of 6 properties, and the tenant pays utilities, 4 of 6 properties. Covered parking is not an option, 4 of the 6 properties. Properties number 1 and 4 are most similar. In each case, the tenant pays utilities, apartments are unfurnished, and covered parking is not available. Property number 2 differs only that covered parking is an option. Comparing rents for the properties produces the following chart. Number 1, 1 bedroom, $250, 2 bedroom, $375, and a 3 bedroom, $450. Number 4, or apartment number 4, 1 bedroom is $245, 2 bedroom, $375, 3 bedroom, $450, and apartments number 2, 1 bedroom $245, 2 bedrooms $380, 3 bedroom is $440. So the typical for your analysis is for the 1 bedroom $245, 2 bedroom $375, and a 3 bedroom $450.
And it looks like that because of if you look at it in columns, there's 2 of the ones they say are typical. There's 2 of each one in each of those columns.
Yeah.
Okay.
Optional covered parking does not seem to have any impact on rents. You do not need to develop any adjustment for it. Instead, you would add parking income as miscellaneous income. Typical rent for an unfurnished apartment where the tenant pays utilities is $245 for a 1 bedroom, $375 for a 2 bedroom, and $450 for a 3 bedroom. You would use this market rent to appraise all 6 properties. For number 6, you disallow any expense for furniture retail since you have not based your income estimates on furnished rates. For numbers 3 and 5, you disallow expenses for tenant utilities. Your income estimate does not include the additional rent collected to pay for them. An alternative is to develop a separate market rents for apartments where the landlord pays utilities. Number 14. The following chart shows the rents for a 75-unit apartment complex. The VNC loss rate for this complex is 16%. Annual net miscellaneous income is $13,500. Allowed expenses are $91,900 per year. Calculate the potential gross rent, effective gross income, and NOI. Did you say read the chart for the rents? Not reading the chart for the rents. You can look it up yourself. So you're going to take the unit type, you're going to list out your unit type, multiply the number of units by the monthly rent, and then multiply that by 12 to annualize the rent. You're going to take that for each unit type, you're going to add them all up, and you're going to get a PGR of $288,000. How'd I do?
Perfect.
Your VNC loss is $288,000 times 0.16 equals $46,080. Your EGR is the $288,000 less the $46,080 equals $241,920. EGI is equal to the $241,920 plus $13,500 equals $255,420. Your NOI is equal to $255,420 less the $91,900, which is equal to $163,520.
Yeah, this repetition is helping.
Okay.
Okay.
Number 15, you are collecting information on mall stores in your area. Your survey reveals the contract rents per square foot shown in the following chart. There are store types, annual rent, percent rent, and total rent per square foot listed, as well as the contract dates. Some contract dates are current, some are from previous years. You are appraising a mall with a total area of 165,000 square feet. Of this area, 95,000 square feet are leased to anchor tenants. Tenants sell retail food. Products take up 18,500 square feet. The remaining space is leased to tenants in the other category. Using information from the chart above, what is the subject property's potential gross rent using the average market rent for each type of space? To answer this question, you must first examine your income information. The first step is to eliminate the out-of-date information. Sorry, I need to move that over. Of your anchor store type, they get rid of the contract rates from 1992. For the retail food store type, they get rid of the contract rates from 1998. And from the other store types, They get rid of the 1994 and the 1995 contracts.
And just the current rents for the 3 types.
Once you've eliminated the out-of-date contracts, you can see that the annual and percentage rents for each type of store conform to a fairly standard pattern. The range for total rents per square foot for each store type is fairly narrow. Using the average in each store type gives you the following market rents. Anchor store average is $6.95 per square foot. Retail food store average $25.36 per square foot. Other store average $13.46 per square foot. The following chart shows how to calculate PGR of $1,822,600 for the subject property. Your anchor stores $95,000 times $6.95 equals $660,250. Retail food $18,500 times $25.36 equals $469,160. Other $51,500 times $13.46 equals $693,190, giving you add all those up, you get the $1,822,600. There is an asterisk next to other here that says the total square footage of 165,000, and then the retail square foot is it's less. Okay, so your total square footage of 165,000 less the retail square footage of 18,500 less the anchor square footage of the 95,000 is equal to 51,500 square feet.
It was asterisk on the other.
You are appraising a Class A office building with 63,000 square feet of leasable space. In your market, prevailing retail rental rates are 88 cents per square foot per month. The VNC loss rate is 14% and management is 4% of effective gross income. Landlords typically pay all utility, janitorial, and fixed expenses. Tenants pay for all furnishings and for building security. Given this information and the operating statement that appears below, what is your subject property's NOI? An owner statement is given. The first step in solving this problem is to recalculate the subject's property potential gross rent based on current market conditions. Market rates indicate PGR of $665,280 and an EGI of $572,141. PGR is 63,000 times the 0.88 per year to annual, or times 12 to annualize it, equals $665,280. Your VNC is equal to the $665,280 times 0.14, which is equal to $93,139. Your EGR is the $665,280 less the VNC of $93,139, which is equal to $572,141. EGI is the same as EGR because there are no miscellaneous income. All of the expenses shown on the operating statement would be allowed. However, we need to recalculate management based on the market rate, 4% of EGI, and check the reserve for replacement to make sure it conforms to appraisal principles. Management 0.04 times $572,141 equals $22,886. These figures, there's a little chart of...
You can read those.
Okay. You have your reserve for cash?
Yeah, it's HVAC, air conditioning, I think.
That's HVAC? C-A-C-H?
I saw it in another text.
Oh. Okay. So the reserve for the CACH is you have a RCN of $112,500 divided by 15-year life equals a reserve of $7,500. The roof is $60,000. RCN is reclaim, right?
Replacement cost new.
Replacement cost new. RCN, the roof has a replacement cost new of $60,000 divided by a 20-year life equals a reserve value of $3,000. The blacktop has a replacement cost new of $10,000 divided by 10 years for life equals a reserve amount of $1,000. Add those up, you get $11,500. These figures give us the following reconstructed operating statement. It indicates NOI of $348,903. And there is a new updated owner's statement.
You can read it. You can give the PGR and the EGI and all the expenses. So there's subtracting the expenses. Okay.
So the new owner statement reads PGR $665,280. EGI is $572,141. Looks like they're subtracting management, property tax, insurance, staff salaries, utilities, supplies, advertising. Those were given amounts up in the upper owner statement.
In the owner statement.
In the first owner statement, and then they're using the new reserve amounts that they're subtracting out. I see what they've done here. They have taken all of those expenses and they have added them up, and they equal the $223,238. And so they're going to subtract that from the. Nope, that's not right either.
Okay.
So the new owner statement lists the PGR of $665,280 and the EGI of $572,141. Then they list the expenses for management, property tax, insurance, staff salaries, utilities, supplies, and advertising, which were stated in the above owner statement. Then they include the new reserves that were just figured out. And they add all of those up to get total expenses of $223,238, and they subtract those expenses from the EGI of $572,141, giving the NOI of $348,903.
Okay.
Adjusting non-typical leases. In mass appraisal, appraisers usually examine lease contracts for a class of properties in order to determine the market or economic rent for that class. The typical length of a rental contract will vary for apartments, retail stores and strip centers, retail stores in malls, office space in small buildings, office space in large buildings, etc. Appraisers must know how locations influence rents. The market rent for a prime location will be higher than the market rent for an inferior location. To establish the influences of location and property type on market rents, appraisers should collect as many lease agreements as they can find and sort them into classes based on physical and economic characteristics. They should then determine the typical lease term for each class and adjust non-typical lease to that standard. In some leases, for example, the landlord, the lessor, pays all property taxes and utilities. In others, the tenant, the lessee, pays utilities but not taxes. Some landlords pay for repairs and maintenance of such property elements as air conditioning. Other landlords require tenants to pay for maintenance and repair. To determine the market rent for a property category, appraisers should first eliminate any lease contracts that do not represent arm's length transactions or that for some other reason do not reflect current market conditions. They should then adjust the terms of actual leases to reflect whatever type of rental contract is most common and select the typical rent from that adjusted rent amounts. In some cases, appraisers can use paired data sets to determine adjustment amounts. For example, if you have lease information for 2 apartment complexes, one apartment rents for $300 per month, but the tenant pays utilities. A second apartment rents for $375 a month, but the landlord pays utilities. If the properties are otherwise comparable, the difference between the 2 lease amounts is the adjustment for utilities. If landlords typically pay utilities, you would add $75 to the rent for any apartment where the tenant pays utilities. If tenants typically pay utilities, you would subtract $75 from rents where the landlords pay them. In other cases, appraisers can use estimated expenses to adjust lease terms to typical. For example, you are trying to determine the economic rent for small office buildings in your appraisal district. Most of the lease agreements you collect require the tenant to pay janitorial service. They indicate a range from $1.20 to $1.35 per square foot. You receive information on a property that rents for janitorial. You receive information on a property that rents for $1.65 with the owner paying janitorial service. You know from a survey if your market that janitorial services typically cost 35 cents per square foot. To adjust this lease to typical terms, you subtract the cost of janitorial service, 35 cents, from the contract price, $1.65, to arrive at an adjusted rent of $1.30. You then add this adjusted lease to the other leases you have collected and select the typical rent from the resulting group. Some leases may involve some sort of giveaway. In such cases, you first find the total payments over the lease term, then divide by the number of years or other payment periods such as months. The result is the adjusted annual rent. Suppose that a commercial building offered 6 free months of rent with a 3-year lease. The contract specifies $15,000 per year. Because of the 6 free months, the property owner only receives $7,500 in the first year. Over the 3-year term, the owner receives $37,500, $7,500 plus $15,000 plus $15,000. The adjusted annual rent is $12,500. When you arrive at that by the $37,500 divided by 3. Once you know the market rent and the prevailing terms in your location, calculating PGI is a simple process. Multiply the rent for each type of unit times the number of units and total the results. After calculating the PGR, you must determine the appropriate V&C rate. This rate should be based on market information. A property may be 30% vacant, but if prudently operated, properties with the same type in similar locations are 10% vacant. You should use a V&C rate of 10%. Remember that V&C rates will vary from one type of property to another and may vary from one location to another.